What is meant by short strangle? As everyone knows that short strangle is simply selling one call option which is having higher strike price and selling one put option which is lower strike price. Like for example, if Bank Nifty is trading around 37,000, selling 38,000 call and 36,000 put, which is also a simple example of strangle. This is what is meant by strangle. The next question comes is what premium we need to select to execute short strangle. It varies from person to person, depend upon their handling abilities and also depend upon their view on the market. It varies. It's not any prefixed thing like we have to sell this premium only. But what we are comfortable, we are going to discuss. We generally prefer to select the call and put options having delta value of 0.15.
Delta value of 0.15. All right.
Yeah. That thereby, if we select those premiums, we had enough space or enough buffer time for adjustments if market moves in single directions or any V-shape movements, highly volatile markets. We have enough time for that adjustment part. So we generally prefer. So we generally prefer options with delta of 0.15. Next thing is whether we have to do weekly or monthly contracts. Weekly and monthly both are having their own advantages and disadvantages. We have to select, depends on various factors like VIX and liquidity and any future events like this. VIX, if in coming days, if VIX is going to increase, then selecting long contracts are not going to yield any return. Why? Because premiums are going to increase only. There is no decay, theta decay will be there as VIX is going to rise. We have to select weekly or monthly according to the situation. We generally do 80% of the trades in weekly contracts. Remaining 20% will be next week or monthly or further for long options. Like this, we will do. Majorly, we will focus on weekly. Why? Because if any previous thing, I just want to mention one example. Starting of the September contract, September ending option premiums, which are 2000 away from the spot price, combined premium will be like around 320 like that. But when it comes to October contract starting, the month ending contracts premium is like around 650 like that. So if a person already executed October contracts in September starting, there won't be any decay for him. Why? Because the VIX shooted up from 12, 13 to nearly 20. So there won't be any decay. And so in order to avoid this, we mostly ended up in doing weekly if VIX is very low. If VIX is very high, then we are very much comfortable in doing monthly options also.
Okay. What is low in terms of number is below 15%, VIX is low and above 15% is high?
No, at present market fear, there is not much fear in the market. At present situation, low will be around 10, 15 below will be considered as a low, but bottom will be considered as 10. If high will be considered as around 20.
Sure.
If it is 20, I am very much comfortable in doing monthly.
Okay.
Whether it may reach 25 also, I am okay with it. 20, I can easily comfortable in doing long options compared with weekly thing. If VIX low, then I am very much comfortable in doing weekly only. Yeah, we generally prefer short strangle when we think market will be in range bound. That doesn't mean always market will be in range bound, right? So if market moves in any one direction significantly, we need to adjust our positions in order to reduce our loss.
Okay.
So after entering into short strangle, we generally follow 5 important rules. These are the 5 important rules which I am going to discuss in detail.
Okay.
And I will show with the example by using option simulator also. First one is if after selecting the option premiums, we came suppose if we select 100 call option, 100 put option, we have to calculate 80% of that premium, and we have to exit when we achieve that profit. That is the first rule. That is 100 combined premium will be 200, and 80% of that premium will be 160. As bank nifty lot size is 25, we get around 160 multiplied by 25, we get 4,000. Whenever we achieve 4,000 profit in that in these options, by doing adjustments, everything, we have to exit that one and move to next week or else next contract. That's the rule number 1.
Okay.
Rule 2 deals with when to do adjustments. If market moves significantly in one direction or any volatile situations, we have to do adjustments. So when to do adjustments? In these two options, if one option, one will be the larger one, right? If the larger option premium is 100% more than the smaller option or simply double than the smaller option, then we have to start the adjustments.
Okay.
So third rule deals with what type of adjustments need to be done. For second rule, I will just give you one example. Like if we select 100 call and put option, if bank nifty falls, then automatically put premium will going to increase and call premium going to decrease. Let's think if put premium increases to 150 from 100 and call premium decreases to 75 from 100, here we can see that 150 is nearly not exactly double to 75. So here we have to start the adjustment. If it is near to double, we have to start adjustment.
So basically what you are saying that the total premium was 200. Moment premium becomes 225.
No, it won't be like that. If one is 100, another one is 100. Sometimes 100 premium, that is call premium also will not move much. It will be 98, 99 only. But this 100 premium become 170, 180, 200 also.
Oh.
We have to see larger premium is how much percent more than the smaller premium.
Got it.
Yeah, only we have to see only that only, not combined premium is not taken into consideration.
Sure.
Rule number 3, we have to remove that small premium. In that place, we have to take call option. In this case, we have to take call option with higher premium. In this, what is the selection criteria for higher premium? We have to take percentage in terms of this larger premium. That is, it should not be more than this premium. That is, it max will be 100% of the larger premium, and it should not be less than 80% of the larger premium. In this case, it should be 80% in the sense 120 is the minimum premium we have to take for adjustment, and 150 is the maximum premium we have to take for the adjustment. By exiting the 75, we can take 120 to 150 based upon the market condition or availability of the premium. We generally prefer below 150, whatever premium will be there, we will select that premium for adjustment.
Okay.
And next thing.
This is point number 3 is not clear, but I guess you will take us through some example which will make this point clear.
Yeah. If you want, I can explain one more time.
No, it's okay. I mean, I think when we see the live example, I think we'll be able to better comprehend.
Yeah, okay. And fourth one is during market closing time around 3 to 3:30, we need to check is there any significant difference between call and put premiums. If the difference is more than 20-30%, we need to adjust the premiums accordingly. Like for example, if one option is 100 and another option is 60, that doesn't mean one option is half or other option is double than the smaller one. Still, we have to do adjustments. Why? Because in order to avoid gap ups or gap downs, we need to adjust that smaller premium by bringing closer to the larger premium. If the difference is more than 30%. That is
30% of the larger premium.
Larger premium. If one is 100, another one is 70, then no need to adjust. But if it is more than that, that is one is 100, another is 65, 60, there we need not to adjust according to previous rules. Rule number 2, it should be double than the smaller premium. Still, by closing time, we take this as a precautionary measure in order to avoid the high gap ups, gap downs. We will adjust that by minimizing the difference between call and put. If there is significant difference only, 70% also we can accept. More than one is 70% of that smaller premium should be at least 70% of the larger premium. Then we don't need to adjust. If it is less than that, then we can adjust on closing basis. After 3, we can consider it.
Okay.
Next, in volatile conditions, in generally, however, whatever the strike price we take, it eventually becomes straddle once in heavy volatile conditions. There we have different options. We can hedge our positions by buying somewhat far OTM options. That's one option. Here I will discuss two options. One is if strangle becomes straddle, then we have call option, put option, right? Suppose if call option is 300 and put option is 200, the combined premium would be 500. We will place stop loss 10% above the combined premium. That is, we are not going to place it in system, but we have to think manually. We have to think in our mind. Like if our combined premium reaches 550, then I am going to exit. If below that, I will be in trade. If theta decay happens, the 500 option premium reduces to 450 every 10%. We will revise our stop loss. If 500 combined premium becomes 450, then the new stop loss of combined premium will be 450 plus 45, 495. Likewise, we will revise our stop loss, but this won't give much advantage. Sometimes it has advantage, but we generally don't do this. We actually ended up doing straddle related adjustments. But this also sometimes those who are not having high capital, straddle related adjustments require more extra options selling that requires more capital. If any person not having more capital means, then they can proceed with this percentage that is 10% combined premium return stop loss. They can exit if the stop loss hit and move to the next week. If they had
I have a confusion when you say that the strangle will become straddle. This is, I'm not very clear. Why do you say that?
If bank nifty is at 37,000, if we do 36,000 put, 38,000 call. If bank nifty moves 500 points down, then we automatically bring call near. We will exit the small call and enter high call, right? We will mostly ended up by doing 36,000 put, maybe around 37,300 call, like that. If bank nifty reverses from 36,500 to again 37,000, that call premium will going to increase. This put premium will going to decrease drastically. So we will bring this put premium from 36,000 strike price to around 36,600 strike price. Again, if market reverses, heavy V-shaped recovery, if it is single direction or limited range, then there is no need to adjustments. There is a limited scope of adjustments. If very high V-shaped recoveries, then eventually that strangle becomes straddle. I will show it with one example also. In that case, we need to do this kind of adjustments.
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.